My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, today we got a counter-trend rally. The Dow dipping 68 points, the S&P advancing 0.33%, another record, while the NASDAQ gained 1.05%. And you never want to be caught in one of these minor chord riffs. They exist to suck you in, but it's usually a trap. So what happened? Well, the CDC put a pause on J&J's COVID vaccine because apparently it can cause blood clots in women. In one case, it was fatal. Even though the risk here is no different than dying from the regular flu vaccine or the birth control pill, the regulators shut it down. And that caused a rotation from the reopening stocks to the lockdown stocks. Think Zoom or DocuSign, Peloton. Now, I don't believe this incident will put a dent in the great reopening thesis. But I want to take the other side of the trade here, especially since J&J hasn't been able to make enough vaccine to be a real factor here. That's a huge disappointment to me. But don't worry. It's all in Moderna and Pfizer, and I have total confidence in both of them. I think this is a good time, though, to reflect on the longer-term trends and worries, not the problems, I think, with J&J, which I ultimately believe will be ameliorated. So on the eve of earnings season, let me take this moment out to articulate 7 concerns that I really am worried about. Ones that help explain why I recently took about $150,000 out of the market, meaning I sold stocks, from my charitable trust, which you can follow along by joining the ActionAlertsPlus.com club. Now, these are less things that keep me up at night. I always hear that, and I hate that. That's not what this is about. They're more, I think, let's call them possibilities that you have to keep an eye on. First are the earnings themselves. This week we have bank earnings, and those stocks have run so much that their numbers need to be borderline perfect if they don't cause, well, you get it. Even though the financials are still relatively cheap versus the rest of the market, yeah, and they've got an improving yield curve, their stocks are coming in way too hot, and that's always a risk. I keep seeing J.P. Morgan, the stock reporting, opening up $1, and maybe $1.50, maybe $2, and then slowly but surely working itself down to be flat, at which point all the people who bought it higher puke it up. Sell. Because they have zero conviction. That's not encouraging. Look, bank earnings are always hard to get your head around. The headlines are a dice roll, and there are lots of dice rollers out there who could immediately be disappointed. So call me concerned that this red-hot group could hurt the tenor of the earnings season. My second concern, inflation. Now, look, I think Fed Chief Jay Powell is right that the current inflation spike is transitory. I see oil up well beyond where the fundamentals dictate, even with the great reopening, because Saudi Arabia wants to crush the U.S. oil industry. So eventually they'll open up the spigot, knock the price down. Crude could fall maybe $10 in a heartbeat if the Saudis even whisper they want it lower. Meanwhile, plastics, a huge building block, right? They're only really up because of severe shortages caused by Superstorm Uri. But what if it takes months to get those plants restarted? Something like that seems increasingly likely. How about this port thing, right? I mean, is it really transitory? Port congestion is causing endless price increases. How long is this going to continue before we don't think it's transitory anymore? Again, I agree with Jay. I don't think we'll have to tighten anytime soon because of inflation. But I've been wrong before, and this is a legitimate concern, even as the consumer price index numbers this morning don't seem all that worrisome. 3, the stock glut. Look, tomorrow Coinbase has its direct listing, and this is one of the largest companies to come public in years. Now, I actually like Coinbase, the stock. More on that later. I like it very much. But we've had so many IPOs and so many SPAC deals that I'm worried about the prospects of a $100 billion direct listing sucking money from everything else. While the SPACs have taken a temporary pause, that will soon end when Altimeter Growth merges with Grab. The East Asian ride-sharing, food delivery, and bank play, digital wallet, yeah, everything, right? Sounds serious. Sponsors sticking around. But the bad SPACs far outweigh the good ones. And anything that lures in new supply, I am telling you, is a problem. Remember, you got to sell to buy. There's not a lot of new money coming. Hey, by the way, at the same time, I don't like that 37% of the tech companies are losing money right now. Do you know that's the highest percentage of unprofitable tech outfits since 2000? Ooh, ominous. Too much supply, too many questions, not enough discipline. Real worry. Fourth concern, we've gotten complacent about COVID. Social distancing, doesn't it feel like a thing of the past? We act like we have the pandemic under control. Yet no one knows whether the vaccines work on all the new variants. I know people are sick of quarantining and vaccinations. Save J&J. They're all going pretty well, though. We're not out of the woods. Right now, do you know that in Ontario, doctors may soon have to decide which patients can get an ICU bed and which can't? Hey, that's not some backwater. That's Toronto. In the U.S., the vaccinators seem to be outrunning the plague, J&J notwithstanding. But what happens if J&J's issue scares people out of getting vaccinated altogether? Still, we're all weary, which means we're letting our guard down. And these new, more dangerous variants could cause the economy to close again. Hence the stay-at-home stocks roaring today on a belief that they will. Fifth concern, we are indeed overbought on the Sp Oscillator that I swear by. At 5 tonight, it's not terrible, but it is where you have to sell something, as I did, because the oscillator is like a thermometer. Tells you if the market has a fear. Remember, I don't own stocks, my charitable trust is the seller. However, we have had an incredible run, and I'd feel much, much more comfortable if we follow that up with a gentle decline rather than some sort of cliff jump. The longer the market stays overbought, the more worried I get. Remember, on last week's Off the Charts, we highlighted a bold top call from the legendary Tom DeMark. He thinks the Dow and the S&P are overextended. The oscillator agrees with him. You know, it's worth being a little more careful. 6, these shortages really do worry me, especially the semiconductor shortage. Without chips, there isn't anything most manufacturers can do to boost production. Ford and GM simply can't cash in on demand, and I don't see that getting better, at least not fast enough. GM had some hopeful news on the tape today, but you know what? I don't think it's going to make that much of a difference. Now, I am glad the president's focused on this issue, but you can't just throw up new factories in a few months. Even the president can't get that done. It can take years. The semiconductor capital equipment companies are already working around the clock to make more machines. That's why Applied Materials, KLA, RAM Research, they keep hitting new highs. NVIDIA can't be the only chip stock to rally, though. And by the way, after yesterday's analyst meeting, I think it's more of a software hardware stock now. We have shortages throughout the system because years ago our companies decided to handle inventory in a just-in-time manner. You can blame our business schools for that. If there's any disruption, the whole system breaks down, and you can't make anything. You know, I got to take China. They operate on a just-in-case basis, so they're in a much better situation to cope with these disruptions. Finally, concern number 7, and this one's got me the most concerned because it's beyond my ken. It's foreign policy. We have a new president. It feels like everyone from Iran to North Korea to Russia, even China, wants to test his resolve. Now, I'm most worried about China, which seems determined to show Biden that it doesn't want to hear anything about human rights or it'll make a move on Taiwan. I actually think they're bluffing, but that's not the kind of thing you want to bet on. To me, this potential flashpoint is the most dangerous storyline in the world right now. I have to hope it's all posturing. But it makes me nervous when China does something like sending 25 planes over Taiwanese airspace last night. Hey, they're playing a game of chicken with a conflict that could possibly trigger, well, some would say World War III. I think that's extreme, but holy cow, I don't like it. The bottom line, look, I'm not a bear, but there are legitimate concerns here, which is why we sold a bunch of stock from my charitable trust on the eve of that conference call I gave last week. Listen to me. This market can handle 1 or even 2 of these potential problems, but it can't handle all of them, not when all these stock is being offered. So why not exercise a little prudence, raise a little cash in case something goes wrong, even if it means buying some Coinbase with some of the leftovers.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.